Hello, everyone. My name is Peter, and I welcome you in the podcast edition of the Tax Bites. Today, we will talk about Amount A, and I have a number of real good experts to talk about that in my virtual recording studio. First of all, Stefan. Stefan is well known for the audience. He's a frequent speaker here and a senior counsel in our team, former part of the Belgian tax administration, and spent several years at the OECD. So, welcome, Stefan. And next to Stefan, we have Gilles. Gilles is director in our transfer pricing team and has a dedicated focus on business transformations. And last but not least, of course, we have Isabel. I don't think Isabel needs much of an introduction here for the audience, but for those who do not know her, Isabel is a transfer pricing partner here in our team. She's been assisting multinationals in all kinds of transfer pricing matters for almost 30 years and is closely monitoring, of course, all the developments in the OECD, Pillar 1, Amount A, and B, amongst others. So with this great audience, I think, and these great speakers, we can talk about Amount A. First of all, maybe Stefan, let's introduce a little bit the topic for the audience. We're going to talk about Amount A, the papers that have been published very recently by the OECD on the 11th of October. And we're going to dive a bit into what's in the papers, what does it mean, and what are the insights that we can gather from the webcast that the OECD has held on 26th of October. So, Stefan, floor is yours.
Thank you, Peter, and good day to all of you. Well, indeed, Peter, on the 11th of October, a series of documents was actually published by the OECD. 4 documents, the actual Multilateral Convention itself, which covers the different aspects of Amount A, and I'll come back to that in just a minute. This is a document of about 200 pages, and it is assorted with an explanatory statement. So actually, you could say this is the kind of commentary to the Multilateral Convention. Quite an elaborated document because it's about 600 pages. So all in all, Multilateral Convention and commentaries are already 800 pages plus. They also published a short overview and very interestingly also a document on understanding tax certainty under the Multilateral Convention. So that is really a very interesting document with regard to tax certainty under Amount A. So as we all very likely will know, this is Amount A is part of the 2-pillar approach. So Pillar 2, introducing a minimum tax of 15%, and that is certainly not our topic of discussion today. We will focus on Pillar 1, but Pillar 1 is also 2 legs, Amount A and Amount B, which are politically tied. Amount B is a standard return for in-country baseline marketing and distribution. That's also not the topic of today, but of course you can listen into our webcast we held earlier. And then the second leg of Pillar 1 is Amount A, which is a reallocation of, let me call it, residual profit to market state. But residual, you cannot compare it to the residual profit under transfer pricing. This is really a formulaic calculation of residual. And what is actually meant is that 25% of global profit exceeding 10% of profit before tax is or could actually be redistributed, reallocated to market states. This only concerns major multinationals. What do we mean with major multinationals? It's multinationals with revenue of over 20 billion with a 10% profitability. Amount A does not substitute the existing transfer pricing model or whatever. It is actually an overlay to the existing system. So the international tax system that we know today remains in place for those multinational enterprises. And this is something that actually comes on top of the existing system. There are 6 building blocks, at least according to the OECD, and as was explained during the webinar that was held last Thursday, 6 steps, 5 of which are there to determine the obligation under Amount A, and there's 1 step also on tax certainty for Amount A and for issues related to Amount A. So as I indicated, the scope is 20 billion revenue, 10% profitability, but as usual, there are some exceptions. So it's not meant to be applied for extractive industries. It's not applied to regulated financial services, not to defense industries, and not to autonomous domestic businesses. These are businesses, the larger part of which are only confined to one country, although they might, of course, pass the thresholds. You also have identification of eligible market jurisdictions. So there are, and we will discuss that in more detail later. There are detailed sourcing rules for different kinds of goods, products, which might make this system quite complicated. Another step is with regard to calculation and allocation of profit, which is based on consolidated accounts, and this certainly does ring a bell with Pillar 2. There are also some book to tax adjustments. This also rings a bell with Pillar 2. They are inspired by Pillar 2 rules. Okay, that's fine. But there are some deviations with regard to the Pillar 2 rules. So again, perhaps adding a bit to the complexity. There are some adjustments for double counting, because how the system works is that you allocate profit to market states, but there is a creation of a new nexus, the sourcing rules, where you actually don't have a physical presence in the country. But if you do have a physical presence in the country, it is possible, well, or very likely, there will already be profit be allocated to that physical presence, be it a permanent establishment or be it a subsidiary. So in order to avoid that kind of double counting, that you consider actually your profit already allocated to the market state based on the existing system, they have developed the so-called marketing and distribution safe harbor. And this is based on a kind of, well, new approach, a new ratio, the return on depreciation and payroll, quite, I would say, quite a brick and mortar based ratio, in order to alleviate precisely the double counting. So in order to determine on a formulaic basis, so it's not the real profit that is considered, but based on a formulaic basis, they are going to deduct a part, or at least try to determine a part that will be deducted for that adjustment for double counting. Also, there is an allocation based on the ratio of locally sourced revenue to the total adjusted revenue of the group. So that is then the ratio that goes to the country. You could compare it actually to a kind of sales-based ratio, and only there is an allocation based on de minimis rules. That is, that you can only have, if you can only have be attributed profits if you have sales of 1 million in the country, but there is an exception for small economies which have less than 40 billion of gross domestic product, and there I would say the de minimis rule is set at 250,000 euro. With regard to elimination of double taxation, because that is an important part, and already from the start of the project on Amount A, there was this call actually that double taxation should be eliminated at all costs. This is also based on the strange ratio return on depreciation and payroll with a 4-tier system actually, where you when you have 15 times the group return on depreciation and payroll, you come in first. You come, if you have the second tier is 1.5 times the group return on depreciation and payroll, and tier 3 and, well, they call it 3A and 3B. That's respectively 10% of the group return, which is considered the standard return, and the other one is then 40%. So this is the kind of 4-tier approach that they use to eliminate double taxation. They also define the relief states, because it's not enough to just to reallocate profit. I mean, otherwise you end up in double taxation, of course. So you have the receiving states and the relief states, which have to surrender a part of the taxable income. So to define the relief states, but also to identify the relief ways. And there's some leeway there if you have multiple entities in one jurisdiction. I mean, if you have one entity in one legal jurisdiction, which is the entity that should actually pay that tax, then the response is relatively simple. If you have multiple entities in one jurisdiction, is a kind of choice of the multinational enterprise which of the enterprises in that country, in that jurisdiction, will actually pay the tax. There's also discussion about the filing mechanism with an amount A return, another return to be filled out, but in an attempt to try to make it as easy or as less complicated as possible, this return will only be shared by the lead tax authority. So usually this will be the tax authority of the multi-parent entity, who will then share it with the other tax authorities of the parties that are in at least where there are presences or where there will be created this new nexus. And this other tax authorities will then also be the relief states or other relief states, receiving states, and so on. With regard to the topic of certainty, and as I already indicated, this was already there from the start of the project. Relief for double taxation was really something primordial in this project. You have three kinds of certainty. Scope certainty with regard to, well, the scope, whether you're in scope or out of scope, and this deals, of course, for the regulated financial services, extractive industries, defense industry, and the domestic enterprises. They can be partly out of scope or entirely out of scope. If it is only, for example, only extractives, they can be fully out of scope, but it can be that they only are partly out of scope if they also have other activities and meet the threshold of 20 billion, 10% profitability as well. Advanced certainty is when you actually introduce your return on amount A, that you can request your lead tax administration for advanced certainty to indicate whether the methodology that you have used, whether the results on the relieving states, on receiving states, whether that can be assumed correct, and there's a procedure that will actually grant you, or that is able to grant you, that certainty. It can look quite complicated, but at least it gives you certainty, advanced certainty even, and it consists of a review panel where there are only tax authorities, I would say chaired by the lead tax authority, and then 3 tax authorities of relieving states and 3 tax authorities of receiving states. And they will consider whether the methodology used is correct, whether the calculations are correct, and so on. If they don't come to an agreement, then there is a determination panel. And this is something like, well, you could call it arbitration, but they don't call it arbitration. It's a mandatory binding solution, which is based on best final last offer. So a kind of baseball arbitration. And this determination panel is actually composed of members of the tax authorities involved, 2 tax authorities, that is, 2 independent experts, so you would say, almost say representing the taxpayer, and 1 independent chair. The outcome of this determination panel is binding upon the tax authorities, but like under the arbitration convention, they still have 90 days to come to a different solution, of course, relieving the double taxation. The last certainty is the comprehensive certainty, and that is if that you can ask certainty for the years to come, whether again your methodology, whether your approach, whether it is actually correct, whether countries can agree, and you also have the review panel, you also have the determination panel. It all looks quite complex, this kind of certainty, but at least it kind of guarantees that there is no double taxation with regard to amount A. There's also tax certainty for issues related to amount A. And what does that mean? Well, transfer pricing, profit allocation to permanent establishments, the existence of a permanent establishment, whether for example, whether the marketing and distribution safe harbor should already be in existence. So these are all things that are related to amount A that can have a kind of spillover effect, but I would say these are kind of pure transfer pricing issues. So in that case, there is also certainty foreseen that the Multilateral Convention actually installs a kind of arbitration, a kind of mandatory dispute resolution panel. If your treaty has already a dispute or an arbitration clause, that's absolutely fine. You can use that as long as it is alternative A under the OECD Model Tax Convention. You can use the arbitration directive. You can also use the arbitration convention because they all have arbitration clauses. But the Multilateral Convention also introduces this kind of mandatory dispute resolution mechanism in case the double tax treaty does not encompass or does not have this kind of arbitration system. So all in all, I would say a big focus also on not only on redistributing part of the taxable profit for the largest multinational enterprises, but also a lot of attention for tax certainty, Peter.
Yeah, thanks, Stefan. That was a very comprehensive overview of the rules, and with all the documents, that was, I think, very useful to have. But that's now maybe one question, Stefan, I still have for you before I move to Gilles and Isabel is what's going to be the impact now? How fast will this come into force, and how much companies will be impacted by this, Stefan? Is that something you could share with us?
Yeah, that's an excellent question, Peter. Well, there will only be about 100 multinationals in scope based on the threshold of 20 billion. But they also indicate that within 7 years or after 7 years, the threshold of 20 billion may be lowered to 10 billion. So of course, then the number of enterprises, of multinational enterprises that come in scope will rise quite substantially. With regard to the entry into effect of the convention, well, you need a critical mass of some 30 countries. And they have, for the entry into effect, created some kind of point system where several jurisdictions have, I would say, been given a certain number of points. The US being the most, I would say, the biggest one that has received the number of points, and you need, or at least the total number of points is about 1,999 to be exact, and you need 600 points based on the points that have been allocated to the jurisdictions. You need 600 points for the countries to decide to enter into effect. So for the time being, of course, we don't know which are the countries that are going to sign and ratify, because also that's important, sign the convention. But so the entry into force will come at a later date. And of course, the big question is, what is the US going to do? Because they have 513, or at least, no, they have 486 points, meaning that if the United States does not ratify the convention, that means that they will never come to the required 600 points, because then they would only come to 513. So the US can really jeopardize, I would say, the entry into force of the multilateral convention. So, but certainly this is not for this year. The signature will be open this year, very likely next year, and whether it will enter into force in 2024, depending on the 30 ratifying countries, or in 2025, that remains still to be seen, and a lot will depend on the position of the United States.
All right, Stefan, thanks. So we're looking at the way you describe it, a complete overhaul of some key principles for the largest companies in the world, potentially that would apply immediately. So, Gilles, you have looked at the rules, I think, in detail. What are your takeaways from this set of rules?
Yeah, so I think if you look at a set of rules with 800 pages of documents, as Stefan explained, there will be a big chunk of complexity linked to implementing the rules in general. If you look at the content, though, of how the mechanism would work for amount A, for me, there's three main areas where there could be a significant impact for companies. That's on revenue sourcing, it's getting relief for double taxation, and it's the link with Pillar 2. So maybe taking those in turn and quickly touching on each of them. So if you look at the revenue sourcing, so Stefan touched on that already. Essentially, that's sort of the core component of amount A, where taxable nexus would be created where it doesn't exist today. And essentially, the taxable nexus is revenue-based. So there would be an allocation of your amount A pro rata to the revenues within a country. And the question then, of course, is, okay, how are those revenues going to be sourced to different countries? And this is where there's quite a lot of complexity in terms of actually implementing that into your systems as a company. So the mechanism, and this is especially relevant for sort of widget manufacturers, so not necessarily digital companies. So for widget manufacturers, they essentially have to trace the sale all the way to the end customer sale. And this is especially tricky for component manufacturers. So maybe just to give that as an example, let's say you're a component manufacturer in scope of amount A. What does that mean? You have to trace, let's say you produce computer chips, and you sell those to automotive manufacturers. You have to then see, okay, I am selling my chip to the automotive manufacturer in a given country. But you then also have to figure out where is that vehicle ultimately sold, on which market, towards an end customer, so towards an individual actually driving that car. So that's something on which a lot of companies will not have visibility today in terms of, where is the ultimate sale towards an end customer made of a product that is integrated into a product of their customer, essentially. So that's very much an area where you could see a big disadvantage for larger component manufacturers who would be falling in scope of amount A, not necessarily from a tax perspective, but from a commercial perspective, because they would have to potentially renegotiate contracts with their customers to try and get that data on where ultimate final sales are made to customers, which their customers may not know either, unless they are in scope of amount A themselves. So that's one area. Second area is on getting relief for double taxation, and that's sort of the mechanism that Stefan explained with the 4 tiers, essentially. The issue here, or the challenge for business here, will be that there can be a few situations which could arise where you would have a structural situation of double taxation. And for me, there's 2 key reasons where double taxation might arise. The first is linked to limitations of the multilateral instrument. And the second is linked to the limitations of the mechanism itself. So the multilateral instrument, basically the relief must only be given by parties which are signing up to the multilateral instrument. So, for example, let's assume a scenario where country A is given an amount A tax, and country B must be is sort of indicated as the surrendering entity, so where you would expect a credit to be given. If country B did not sign up to the multilateral instrument, but country A did sign up, then the company would have to pay amount A tax in country A, but would not get the relief in country B. So the calculation would still happen as if country B is part of the system, but the ultimate relief would not be granted if country B did not sign up to the multilateral instrument. And of course there, because amount A is a reallocation of taxing right, you will have a sort of incentive almost by companies who will be losing out, so who will be surrendering more than they are getting amount A tax. They would have an incentive, of course, not to sign up to the MLI, which could then mean that structurally for businesses, there would be a structural double taxation. The second piece is then limitations of the mechanism itself. And essentially those 4 tiers, Stefan touched on it briefly, but it's a fairly complex calculation mechanism to determine which of the entities fall into those 4 tiers. But it could very well be that you don't have enough entities going into your surrendering tiers, that, well, the consequence of which would basically be that you don't surrender your full amount A profit allocation. There is a mechanism which is foreseen that if there is a shortfall, so if you cannot surrender all of it, that this is carried forward to the next year. But of course, if that is a structural situation, you just get a structural carry forward of that shortfall and sort of a build-up over time without ever having used all of it. And then the third point I wanted to touch on is sort of the link with Pillar 2. The first thing I wanted to mention there is there will be, again, another set of books which will have to be kept for all of the adjustments linked to amount A, in addition to the Pillar 2 books, if you will. And then the surrendering mechanism, so coming back on that, so the surrendering mechanism for the amount A tax would be through a direct payment, a refundable credit, a non-refundable credit, or a deduction. So it would be one of those 4 mechanisms. If it's the first 2, so direct payment or a refundable credit, the impact for Pillar 2 would be, not that much of an impact. But if it would be a non-refundable credit or a deduction, there's a question on how this would play out for Pillar 2. And in the OECD guidance for Pillar 2, there was sort of a correction foreseen for Pillar 1 and amount A specifically. But in the EU directive, for example, that's not necessarily included. So there's really a question there. Imagine that you have an amount A tax in country A and country B surrenders it. And country B surrenders it through a non-refundable credit. It might be that you then have a top-up tax through Pillar 2 at the level of country B, even though an amount A tax was paid in country A. So you would expect that it would be a bit more similar, that there would be a correction like what was foreseen in the OECD guidance, but will be interesting to see how that will ultimately work out under the EU directive, for example.
Yeah, thank you, Jill. That's very interesting takeaways, and thanks for sharing that. And I imagine, Isabel, you have many years of experience. I guess you have not seen this kind of proposals every year in your career either. So what do you think of all of this?
Thank you, Peter. Thanks for having me. Luckily, we don't have these every year, or I'm not so sure whether I would still be in business and not have been taken away with a straitjacket or something like that. But maybe a couple of things, and let's try to stay within the 30 minutes for the podcast. So first of all, I would like to make a link with a conference that took place last week, organized by the EU, the Parliament, the Commission, and it was about taxes, the future of taxes in Europe. And there were quite some stakeholders talking about, will Pillar 1 actually happen? Does it go far enough, etc., etc.? But I think what's very important to keep in mind is a statement that was made by the IMF representative, who was saying, this is a revolutionary development because this is the first time, and this is the first time in my professional career as well, Peter, that an agreement is reached at global level on the principle of taxing residual profit. So let's set aside maybe the comments that are made by a couple of countries, the fact that we have that point system, et cetera. But as to the principle on taxing residual profit, I think a lot has to be said about that, because this means that we're gonna see, if it goes through two systems, an ordinary transfer pricing system, so to say, and then the new system, as was already eloquently explained by Stéphane and Gilles. But what does this mean for the ordinary system? Well, there is going to be more empathy with profit splits, because there is an embracing, so to say, of taxing residual profit. So it might be good to take a look at your business model, even if you're not a very large multinational, and to see how vulnerable am I from a profit split perspective, so to say. Obviously, as Gilles was saying, the sourcing mechanism, now I'm talking about the new system, is very complex. It seems as if, despite quite some comments that were made on the way to operate that, this is something that is still there. Third one, the third takeaway is, well, the calculations similar as Pillar 2, but not that similar. So you have to keep a separate set of books. Will the dispute resolution work? I think a lot of work went into that. There is quite some opportunity, as Stéphane was already saying, and if you already have a treaty with an arbitration clause in it, well, this can only add some more pressure on making dispute resolution work. I appreciate we're not yet there, but even if it's a baby step, it's a step forward. And then the last point is, yeah, obviously, if there won't be an agreement, well, there will be an opening for more digital service taxes. So unfortunately, this is something for which I think taxpayers need to be prepared at the end of the day anyway. So with these points, Peter, I would like to revert back to you, but the main takeaway is take a look at your business model. Is there a vulnerability to have tax authorities claim that there are unique contributions even under the ordinary transfer pricing system? That's what I think we're going to see going forward.
Oh, thanks so much, Isabel. Yeah, historic development, and I think even if it would not come through the amount A, then the real risk indeed, the digital service taxes that you mentioned, it's often overlooked, but then we see quite some things happening, I think. So thanks a lot, and that's why I think it's so useful to have this discussion, to have the overview, Stéphane. Thank you very much for giving us that comprehensive view on what's on the table. And then Gilles and Isabel for your takeaways. That's great. Thanks for sharing that with the audience. And for the audience, thank you for tuning in. Hope to see you in the next episode of the Tax Bites.